Hello everyone, investment scams rampant. Please vigilant and discerning. Do not trust information from unknown sources. Please make sure recognize two official Capital Securities community, Facebook, Capital Securities, YouTube, Capital Wealth Insights.
Oh, hi everyone, I'm Dong Jessin. Hi Tony, welcome to my live stream on the very last day of the year. Let's get right to it. Today we have two topics, and I hope after we finish those, we'll have some time to just chat casually. So, the first thing, this was announced last night. I think the most important thing from last night was the minutes from the Federal Reserve meeting. The officials' opinions were divided, but I think that's not really the thing we need to be most cautious about. Actually, I mentioned this yesterday, but today I'll go into more detail and present it to everyone. Also, regarding the annual review, today we'll be looking at the three major sectors where the Magnificent Seven are concentrated. Here, it's basically AI that's been fluctuating. Still, I want to remind everyone that within AI, there are some issues, and I think, combined with what we'll talk about regarding interest rates in a moment, you really need to set your expectations. Actually, the start of next year, the difficulty of operating in the market won't be low. Because, well, the bull market has already entered its third year, so people are going to be looking at things much more carefully. That's why today we're going to do a review for everyone. And then on Saturday, we'll basically do an outlook for next year. Take a look at what we can expect from the US stock market and what we might need to pay attention to. Now today, we saw that the meeting minutes show that there are serious disagreements among the officials internally regarding the degree of tightening and the outlook. For this part, since it's from the article above, of course it's translated from English. It mentions prudent judgment. After careful consideration, they decided to cut interest rates. So careful consideration can basically be translated as having a detailed discussion before deciding to cut rates. As for, there are widespread differences regarding the pace at which monetary policy shifts from being tight to neutral, as well as the economic outlook. Okay, so if that's the case, let's take a look at the developments in a bit. It's very likely that the meeting in January next year, the Fed probably won't cut interest rates, and what's important is that there definitely won't be a rate cut in January. So will they announce when they might cut rates? Probably not either, because things are about to get a bit more complicated, a bit more... We'll have to wait and see what the numbers say. So the expectations for a rate cut here, there will be some fluctuations, and I think at the beginning of next year, this will have some impact on the US stock market. And then it was mentioned here that most participants believe that further rate cuts might be appropriate, but some think that keeping rates unchanged for a period of time would be more prudent. So we'll see this tug of war going forward, meaning when January comes, we'll have to see if more people will want to wait and see, if the number of people who prefer to observe and hold off increases. If that number increases, it's possible that there will be a pause in rate hikes. All right, that's something I wanted to report to everyone. Now, moving on to the next point. Most participants in the future believe that rate cuts might be appropriate, but the problem is, as I just mentioned, that is, keeping interest rates unchanged for a period of time might actually be more appropriate. This topic will definitely continue to be debated. So as for how many votes there actually are, that's still uncertain. And as we mentioned to everyone yesterday, right now the expectation is, roughly, it's expected that there will be a chance for a rate cut in the first half of the year, and another chance for a rate cut in the second half of the year. So that's something everyone should pay attention to. In addition, many of the participants, that is, the officials, believe that the impact of tariffs on core inflation is expected to weaken, which is good news. Also, a few participants think that the labor market is relatively fragile and may be worsening. Of course, as you just mentioned, these are the members who are considered dovish. So in summary, next year's inflation expectations have been revised downward, while overall GDP is expected to grow at a moderately faster pace. So looking at it from this perspective, I think if we translate the main point, it basically means that while there is room for rate cuts, there really isn't any urgency. We should especially mention one of the officials present. Do you think the officials might feel there's no rush to cut rates in January or March? January is definitely out of the question for a rate cut, so it's likely that neither January nor March will send any signal about a rate cut. Okay, so what we want to talk to everyone about here is the issue of timing differences. So, what does this timing difference mean? It means the difference between when the market expects a rate cut and when the Fed actually takes action. From what we see now, I think this is a foreseeable variable at the beginning of next year. Because there are two types of variables. One is foreseeable, and the other is unforeseeable. Usually the unforeseeable ones are more like unexpected events, while the foreseeable ones are things you can more or less anticipate. If a foreseeable variable occurs, it usually has a smaller impact on the market. Okay, so looking at this now, the market, everyone thinks that the rate cuts in 2026 will exceed the Fed's expectations. Well, that's for sure, because what the Fed has projected is on the higher side. They've only indicated one rate cut, and only in the long term is there room for further cuts. But what is the market expecting right now? If you look at the interest rate futures, it's predicting 2 rate cuts. But according to market research and analysis, from Brembo's perspective, most analysts are seeing about 4 opportunities for rate cuts. So let's take a look at this. There's actually a pretty good explanation here. His conclusion, which I'd like to share with everyone, is that the employment data will come in below expectations. So the Fed will take a cautious approach to rate cuts at the beginning of 2026. This kind of resistance or hesitation is expected to gradually fade over the course of the year. Bummer predicts that the Fed will cut rates by a total of 100 basis points in 2026. Personally, I find this perspective more acceptable, meaning that this year and next year there should be 4 rate cuts, not just the one that was expected or the 2 that have been indicated. If it really is 4 times? But right now, the Fed is only signaling 1 cut, and the market is only expecting 2. If there really end up being 4 cuts before that expectation actually takes shape, it would be helpful for the market. However, we do see a bit of a problem this year. The economy will gradually slow down. And this doesn't mean there's a specific tough gate within the year, so as things gradually slow down, it also doesn't mean that rate cuts will happen immediately. The reason why this could be quite troublesome, which we'll look at in a moment, is that it's related to inflation expectations. If inflation doesn't drop fast enough or by a large enough margin, then the Fed's room to maneuver is pretty limited. And when that space is small, the current optimism that's supporting stock prices is more likely to be challenged. All right. So what we want to talk about here is that for next year, the current market consensus forecast is roughly 3.0 for the first quarter, 3.0 for the second quarter as well, but then it will drop to 2.8, then 2.7, and eventually down to 2.5. But we want to point out, if you look at the blue line, that's the market survey consensus, which is compiled from the analyses of various institutions. It's the timing of the decline, the timing when it starts to drop, is actually a bit later. You can see it happening in the third quarter, the third and fourth quarters of next year, and even into 2026. Even in the first quarter of 2027, it's still at 2.5. Now, according to Bloomberg's own forecast, it peaks at 3.0 in the fourth quarter, but then it starts to go down. The problem, though, is that it only drops to 2.9, 2.9, 2.8, 2.7. The pace of decline is actually too slow. If the overall rate of economic decline is perceived as being too slow, then the Federal Reserve's available room to significantly cut interest rates will become much more severely restricted and limited. As for 2026, like I mentioned before, rate cuts might be more of a wait-and-see approach, watching how the economic data plays out. The first thing to watch is employment. It'll probably still be weak, but as long as it doesn't collapse, that's relatively good. If inflation keeps going down, that gives more room for rate cuts, so then they can cut rates. The pace at which inflation drops will be the main factor determining how much room there is for rate cuts. As for employment data, it can be not so great, but it can't be too bad, because if it gets too bad and there are worries about a recession, even if you rush to cut rates at that point, whether or not you can actually reverse the market's worries about an economic downturn is a huge variable. So that's one thing you really need to remember. Another point is that the market can't collapse. Also, the AI bubble, it can't burst. It can be questioned, but it can't actually have real problems. These two things are probably the most important foundations for how the market will perform next year. In addition to these, the third leg, which is also very important, is about the times we're in. Trump. There can't be anything too extreme from Trump's side. It can't be like this year, where something totally unexpected happens, like his reciprocal tariffs, which were basically a blanket attack. That was something nobody saw coming. If we don't have factors like that, then in theory, next year should still be a bullish year. Another thing to watch out for is the timing difference. There's also a timing gap related to Xi Jinping's term. So Chairman Powell's term ends on May 15th, and his term as a governor, well, it's kind of a coincidence, runs until January 31st, 2028. As for Trump's term, when does that end? In principle, it's either January 23rd or 21st, 2028. The exact date depends. It depends because the transition of the US president is determined by, first, it's based on the week. I think it's after the election, the second or third Sunday or something like that in the following year. There's a specific rule for the handover. So the date is calculated by which week it falls on. That's why the date isn't fixed, but it's basically set to end around that time. And, well, in theory, it shouldn't be delayed until the 30th. The 31st. So it won't drag into February. So as for Trump's term, well, sorry to say, but Powell's term as a board member actually lasted longer than Trump's. Okay, so now there are two questions from the other side. The first is about the board member nominated by Trump, who is also a chairman. If the nomination passes the hearing, but when it comes to actually taking charge, I expect that probably won't happen until May. Even if the handover is done as early as possible, it'll likely be May before the new chairman really gets a handle on things. There will be some opportunities in terms of administrative management at the Federal Reserve, but there's another thing to be careful about. There are probably two things. The first is about the Federal Reserve board member. This stubborn issue with Powell might come up here. Why? We mentioned yesterday that Trump criticized Powell again on Monday, saying he wanted to fire him. There's also a possibility that he might sue him over the issue of renovations to the Federal Reserve building. Actually, if you keep making threats like this, if you were Powell, you'd probably think, well, I need to make sure I have something to protect myself. That is, so I won't resign from this position, I'll just sit there and wait for you. After Trump steps down, then I'll step down with you, so I can safely step down too. But if Powell just sits there, then in that situation, the chances of him suddenly becoming the target of public anger and resentment are pretty high. So this is a big variable here. Also, we need to mention the new board member. They still haven't announced who it is. Usually in the stock market, there's a common situation. When good news isn't announced, people keep dreaming about it. But once the good news is officially announced, it's no longer good news. So this is something to watch out for. Once Trump announces his pick for the Federal Reserve chair, the market might immediately start speculating and trying to figure out how much room the new appointee has to cut rates. How many basis points of rate cuts are possible? If the market figures it out and thinks the rate cut potential isn't big enough, that could be a problem too. So we want to point out a few things here for everyone to keep in mind. Very soon you'll see, for example, since January is just around the corner, you'll see the announcement of the Federal Reserve chair nominee right after that. Could this actually be a sign that all the good news for the market has already been priced in? And then the second thing is that the Fed is going to have a meeting on January 28th, 3rd, 29th. Okay, pay attention here. It's pretty certain they won't cut rates, but what's really important is the tone and content of their communication afterward. So I want to point this out to everyone. For now, of course, the market probably won't react in the next couple of days, maybe not even by Monday. This is something you need to keep a close eye on in the short term. Also, regarding what I just mentioned, the key point about the room for rate cuts, my analysis here is more rational and objective, based on this. So, the Federal Reserve, the relationship between the benchmark interest rate and inflation is important, but the new Fed chair might actually lower the benchmark rate below the inflation rate. For example, inflation has now dropped to 2.7. But he could directly lower the interest rate to 2.5. And that's possible. It has happened before, like during QE. When they were doing QT, this kind of thing also happened. During QE, for example, the interest rate was close to zero, and then this zero or zero interest rate is actually even lower than the inflation rate. But what we need to point out is that back then, when the interest rate was lowered to zero, inflation was around 2%. Not quite up to 2.5, somewhere in that range. But now, the interest rate, looking at next year's fourth quarter, it's still around 2.7 or 2.8. If the rate is cut too quickly or by too much, there will definitely be people in the market questioning whether the policy is a mistake. This risk will surface. So what this tells you is that while there will be rate cuts next year, it's going to be quite difficult. How to cut rates in a way that's skillful so that the market, stock investors, or even Trump are satisfied, but without causing problems, that's the key. So here, instead of immediately doubting whether it can be done, you should recognize that it's a tough challenge. Next year, keep your eyes wide open and pay close attention to all the details. So that's the part about the Federal Reserve here. Now, let's also give everyone a quick summary. This is the situation with the 2026 tail-end votes. Powell is considered neutral. This is a summary from our chief economist, and we basically accept his summary. For example, Powell is categorized as neutral. If you ask me, I think Powell is a dove. He's not really a hawkish person. He's just, well, selectively hawkish. As for the others, Jefferson is a dove, Barr leans hawkish, and Michelle Bowman is a dove. Actually, that's not quite right. She used to lean hawkish, but now after Trump came in, things have changed. She and another two have turned dovish. Then Lisa Cook leans hawkish. Actually, let's talk about everyone together. Waller is a dove, and Miranda is also a dove. But let me tell you something. In fact, the governors and the vice chair, in theory, unless they have a very clear personal stance, they're not really doves or hawks. So if the chair wants to go east, they go east. If the chair wants to go west, they go west. Just wanted to explain that to everyone. Also, the New York Fed is considered the third most important position in the Federal Reserve. So, as for his statements, recently he's been sounding more dovish, but before that he was more hawkish. So it looks like he might be leaning more dovish now. As for the other four regional Fed presidents, Boston, Chicago, St. Louis, and Kansas City, well, actually, Boston is relatively neutral, but actually, compared to before, it's become a bit more dovish. Previously, it was more hawkish. As for St. Louis's Musalem and Kansas City's Smith, both of them are indeed more hawkish, especially, they're both more conservative than I expected, because sometimes when someone just takes office, it's not clear what their stance is, but after a few speeches, you can see that these two are more hawkish, more on the hawkish side. Now, what we need to talk about is, if we really want to make a significant rate cut next year, it would require the doves. If you can't get the doves on board, right now it looks like there are only 3 for sure. If you add in a chairman being replaced, that makes 4. But to get a majority, you'll still need to work a bit harder. So in this case, the communication from the chairman at next year's annual meeting is going to be extremely important. He can't just use Trump's old school approach of saying, I want you to cut rates, period. If he tries that within the Fed, he's going to hit a brick wall. So what I want to say here is that the expectation for rate cuts is real. I also expect there will be rate cuts. But my expectation is based on, first, the fact that inflation data will gradually ease, so there will be more room for rate cuts. At the next Fed meeting after the new chair takes office, there should be room for about a 100 basis point rate cut. This is much more than the current expectation of 25 or 50 basis points, so it's still a relatively optimistic outlook. But if Trump hypes it up and makes people expect a 150 or 200 basis point cut or something like that, then the gap between expectations and reality will become a big problem. Also, as for the chances of an upgrade or downgrade, let's take a look. Well, let's talk about it. For the June FOMC meeting, there's a clear probability of a rate cut exceeding 25 basis points, meaning the market generally expects 1 rate cut in the first half of the year. Then, moving into the second half, starting around September, the probability of a 2 rate cut scenario starts to emerge, with the chance of more than 2 rate cuts becoming apparent. So the general expectation here is, in other words, after the third quarter, that is, after September, there should be another rate cut, more than just 1 additional cut. This is the expectation reflected in current market trading. However, we want to point out that from a research perspective, it might actually be just 1 rate cut. I also expect it to be just 1 cut. So what we want to highlight today is the importance of paying attention to the timing difference. There is a timing difference regarding the selection of people for the symposium, and then there's the speed at which inflation is coming down, which creates a timing gap for when policy space opens up. These 2 timing differences are likely to be very important factors affecting monetary policy. Next, let's first take a look at the performance of the financial markets, and then we'll move on to our second topic for today. So, as for the US dollar, on Wednesday, it went up by 0.13%. Oh, actually, it was up 0.13% on Tuesday. And today, Wednesday, it continued to rise. However, the main focus in the currency market yesterday was actually on the offshore renminbi breaking through the 7% mark. This feels like China's People's Bank by the end of this year. Actually, it's been a while now. Ever since Trump and Xi Jinping had their talks in South Korea, it seems like the renminbi has gradually started to appreciate. But it wasn't until after December that the appreciation became more obvious. Now, it's already broken through the 7 mark. So the People's Bank is still controlling the pace of the renminbi's appreciation, but they haven't tried to reverse its upward trend. So in the short term, it looks like the renminbi will probably remain relatively strong. Okay, so today the Taiwan dollar closed stronger at 31.49, or was it 31.47? This is about the highest it's been in several years. Now, what people are watching is whether before the expectation of a rate cut early next year really takes shape. The US dollar might strengthen, which could mean the Taiwan dollar has a chance to weaken a bit. But this is still a bit of a tug of war, so let's keep an eye on it. Basically, by the end of the year, the trend is for the Taiwan dollar to depreciate, because it usually appreciates a lot mid-year, then weakens afterward. So in the short term, there could be some depreciation in December, and then in January, we might see some pullback. Let's keep an eye on that. Let's keep watching for now, but I think the US dollar is generally expected to be weak, so the Taiwan dollar's exchange rate shouldn't be too weak either. Now, about the 2-year bond yield, actually, the US Treasury yield, as for the bond market, yesterday it went down, and the 10-year bond also dropped. What's a bit different is that the bond market today, well, it'll close early at 2 p.m. US time this afternoon. But the US stock market trades until 4:30. That's 4:30 local time, so that's a bit different. So even US Treasuries dropped yesterday and today because of the shortened trading hours. I think this trading volume might be relatively low, so the fluctuation in interest rates probably won't be too big. As for the 10-year Treasury, it also dropped yesterday. So again, there shouldn't be much change expected here. As for the S&P, it closed with a slight drop again yesterday. So overall, US stocks traded lightly, so they closed slightly lower, and the performance of large tech stocks was mixed. This is actually just like what we're talking about today. The whole AI sector is showing a volatile and divergent trend. This situation, I think, will continue for a while. Yesterday, the leading gainer was AES. This might not be very familiar to everyone. AES is a power management company. Recently, actually, after the surge in demand triggered by AI and the increased power needs of data centers, everything related to this topic is still moving. So electricity is one aspect, copper prices are another. This might be something everyone is noticing. Let me give you a quick update. Also, Occidental Petroleum went up by 2.6%. Monina Medical Insurance rose by 2.47%. Newmont rebounded yesterday, but oh, sorry about that. It seems like this part hasn't been updated. This might not have been changed. I need to check the top 10 section. It looks like it wasn't updated, but the chart below is correct. So yesterday, the energy sector was up, communication services were up, and industrials and utilities were also up. For utilities, it's mainly the electricity sector that's rising. As for the declines, it's mostly in non-core consumer sectors, which dropped more significantly. But if you look at the declines, they're all around 0.2 to 0.3%, so it's pretty concentrated. Now, let's take a look. The S&P Volatility Index rebounded yesterday. The market is correcting, so it's bouncing back, but I think the rebound won't be too strong, meaning the correction itself shouldn't be too severe. Also, the Equal Weight Index went down. And then the equal-weighted AI sector also dipped slightly. I think we need to keep up with this, meaning that... So keeping up means, well, downplaying the impact of AI, and continuing to focus on the performance of non-AI stocks. We might have to wait until after the start of the new year to see a more obvious divergence in performance. Now, why do I say this? Let's look at the Dow Jones. Actually, for the Dow, yesterday United Health went up, Chevron went up, and so did Boeing, Goldman Sachs, and IBM. Well, some of the big names like IBM and American Express actually went down. What we need to point out is that the Dow Jones doesn't have that many tech stocks, so it went up. But did anyone notice? The Stoxx Europe 600 index has actually hit a new high. In a bit, if we get to Brembo, we can even take a look at that. So the Stoxx 600 has reached a new high. But do y'all know that? Well, there aren't any AI stocks in the European markets. Right now, there are basically 3 major places in the world with AI stocks. The first is the United States, the second is China, and the third, where is it? The third is Taiwan. In fact, Taiwan's AI sector might even be leading the rally more than the others. It might even be more obvious than in South Korea. So, from our perspective, the European markets have already hit new highs. What does this mean? It means that even without AI, they can still reach new highs. So here, we expect that the Dow Jones might have a chance to copy what's happening in the European markets. Why? Because later, we'll talk about the doubts surrounding AI. Those doubts are still there, and they won't disappear so quickly. It can go up, but it might not be as smooth as before, where it just kept rising easily. Now it might go up and then correct, go up and then correct again. Why? Because there are people in the market who will question this and that will make the stock price movement less clean and straightforward. So I just wanted to add this point for everyone. As for the Nasdaq, yesterday, Tuesday, it also dipped slightly, and the Philadelphia Semiconductor Index also had a small drop. The leading gainers were Intel, Rambus, and Marvell. Rambus going up also tells you that traditional memory is doing fine. Then KLA and Lam Research were down, Applied Materials was down, and Teradyne was also down. So actually there aren't any really big companies here. As for the Magnificent Seven, they're still showing some divergence. 4 went up and 3 went down. But the issue is that the ones that went up only had small gains. Nvidia rose 1.1, Amazon went up 0.2, Google increased by 0.09, and Microsoft was up 0.08. Apple dropped 0.25, Meta fell 0.36, and Tesla was down 1.13. So looking at this, it's clear that. So breaking it down, each performed differently. Now, yesterday, the numbers that were released are highlighted in red boxes. The green one, which is the ADP weekly employment data, was supposed to be released, but it seems like it was canceled, so we didn't see it. So here are a few of the released figures. The FHA House Price Index, for example, came in better than expected, and the S&P Case-Shiller 20 City Home Price Index also rebounded month over month. Also, the Chicago Fed's manufacturing PMI came in better than expected, but as I mentioned earlier, the most important thing is still the Fed meeting, which showed a somewhat divided and cautious stance, as I just reported to everyone. Then, today at 9:20, we'll have the jobless claims numbers. Normally, these are released on Thursday, but because of the holiday, the numbers are being released on Wednesday instead. I think the market is just too quiet right now. When these economic data come out, people probably won't pay much attention. I expect it will stay this way until the end of the week, since on Thursday and Friday, what's coming up is the S&Ps. The final value of the US manufacturing PMI, but it's clear that this isn't as important as the ISM manufacturing index that's coming out next Monday, so any real market-moving changes might not happen until next Monday. Today, we're going to talk about, or rather, take a look at the AI volatility segment. So the focus today is on the 3 major sectors where the Magnificent Seven are distributed, which are also the sectors with the largest weight: technology, consumer discretionary, and communication services. Let's take a closer look at these sectors. What's a bit surprising is that not all 3 sectors have outperformed the S&P. Why is that? It's because consumer discretionary has lagged behind. Technology and communication services, on the other hand, have performed better. The unexpected part is that the sector with the biggest gains, the one that has outperformed the S&P the most, isn't technology. It's actually communication services. Let's first talk about the Magnificent Seven. When we compare the Magnificent Seven to the S&P, it's basically about whether they're outperforming or underperforming the broader market. In the US, we don't really have a single broad market index, so we use the S&P 500 as a reference. Google's gains have indeed outpaced the S&P, but the thing is, Google only started its rally after a gap up in September. So what I want to point out is that its strong performance didn't run from the beginning of the year all the way to the end. It actually started later on. Towards the end of the year, or more like in the second half, there was a turning point, and that's when the stock started to rise. I remember at that time, it was because Google passed an antitrust case in the EU, and also didn't have to break up its op division. Then later, they launched their latest model, Gemini 3, which received a lot of praise. That's why Google ended up having the biggest gains this year. So you see, it proves something. Winning early doesn't mean you'll win in the end. Just because you were ahead as a kid doesn't mean you'll stay ahead. Google actually had the biggest surge at the end. Nvidia and others did well in the first half, but the thing is, after August, it actually entered a phase of high-level sideways consolidation, basically moving sideways at a high level without making new highs. Of course, recently there have been some doubts about AI, so Nvidia has also been affected. So everyone is showing this kind of high-level, sideways, and volatile trend. Apple and Facebook. Apple, Amazon, Facebook, Microsoft, and Tesla actually had smaller gains compared to Trump. Well, actually the S&P. Apple has been showing a slow upward trend, while Amazon, Facebook, and Microsoft all experienced corrections after November, which means their third quarter was basically... After the release of the second quarter earnings reports, people started to question the AI capital expenditures. And once those doubts began, the stock started to drop sharply. The first company to be questioned at that time was Facebook. After their AI acquisitions, were they investing too much? Of course, later on, it also got tied to the whole OpenAI and Oracle situation, but Amazon's situation was also relatively weak. Previously, there were doubts about whether their investment in cloud services was too much. Microsoft was doing a bit better, but after early November, they also experienced a pullback. As for Tesla, it's still down this year, but actually, people might have forgotten a bit. At the beginning of the year, what was it up to? It was all about Dogecoin, right? That even led to death threats, so things got pretty intense. Australians aren't really buying Teslas, so up to now it's still being affected by political factors. The volatility this year has been pretty significant, and the returns for funds this year are still negative. So I think we should take a closer look at this. I think here, the Magnificent Seven are showing you that the gap between the good and the bad is starting to widen. Okay, so this is also kind of like what happens at the end of a rally. This kind of thing is possible. During the main upward phase, everything tends to go up together, but later on, it might, there will be some divergence in performance here. This area might consolidate, or it could even form a topping pattern, but right now we just don't know. Sometimes you only realize what happened when you look back later. So what we want to point out here is that among individual stocks, the Magnificent Seven are starting to show bigger differences in performance. As for other AI stocks, we generally use the 200-day moving average to gauge their strength or weakness. You could even say if a stock is above the 10-day moving average. If it's above the moving average, then you could consider it strong. For example, Micron has hit a new high, and memory stocks are doing really well this time. Right now, things are looking great. Not only is memory doing well, but it's also driving up Seagate and Western Digital. Both are performing nicely. But here, we need to pay attention to something. If things continue to go well like this, it's possible that in the short term, the concept of rising memory prices and tight production capacity will persist. This would be good news for this group of stocks. Of course, whether good news could turn into bad news depends on whether downstream players can absorb the cost increases. Now, aside from that, things are still looking strong. As for those stocks that are consolidating at higher or mid levels, Broadcom and AMD are clearly doing very well. These two haven't shown much weakness. So the expectations were really high, but the problem is that when the earnings reports came out, they just weren't good enough. For example, Broadcom mentioned that their gross margin might decline from 68% down to 67%, and then the stock dropped for a while. So that's what happened. AMD said that their revenue would hit $10 billion in 2027, but sorry, everyone is looking at 2026, so their stock also dropped for a while. As for Qualcomm, they wanted to shift from focusing on mobile phones to AI, and after making some headway, things have leveled off again. Marvell is also relatively weak. Then there are two Extra Labs and Altria Networks. These are also basically in a mid-range consolidation phase. As for the weaker ones, Oracle is definitely on the weaker side. It's still below the 200-day moving average, but at least it stopped falling. It's important to keep a close watch on Oracle now. As for SMCI, keep monitoring it as well. Co-Wi-Fi also seems to be stabilizing. Previously, ServiceNow was under quite a bit of pressure, and was also relatively weak. But now, there are a few things we especially want to mention to everyone. First, going back to the previous page, there have been some doubts raised about NVIDIA, like whether NVIDIA has falsified accounts or something like that. To be honest, I think that's a bit much. If you say NVIDIA is falsifying accounts, I really don't think that's possible. But if they're giving some orders to smaller companies, is their collection of payments always 100% proper? There are indeed some variables here. Anyone who has done business knows this. Once you get out there, you know it's impossible to have zero risk. It's right to be cautious about this. But to say they're cooking the books, I think that's an exaggeration. However, is it possible there could be bad debts? That can't be ruled out. Now, as for Oracle, someone said their CDS are high. So let me tell you, Oracle is a company with technical capabilities. As long as your company itself has technical strength, even if you really run into problems, if there are financial issues, when your stock price drops low enough, someone will come in and acquire you. All right, as long as your company is truly capable, when you run into trouble, the worst case scenario isn't bankruptcy. In a market like the US, it's not about going out of business. Instead, someone with more money, or maybe your suppliers or competitors, will just acquire you. That's all. So we have to point out that Oracle does have technical capabilities. Don't forget that. But its problem is that its capital expenditures are too high, and that's a fact. So it has to face that issue itself. And what else? Back in November, I mentioned that the narrative logic around AI needs to change. In other words, the way we currently paint a picture of AI's future, this approach is already being questioned. If you just keep repeating the same story, making it bigger, louder, and with even larger numbers to try to change the market's perception, that's not really possible. What you need to do is actually take some different actions. Once you've done it, or once it happens, that's when the market starts to change its perception of you. This is what we call a change in narrative logic. So recently, we've also seen a few news stories. The first one is about NVIDIA and James. Let me take a look. The report says this company is a startup and it's just forming an alliance. Not something people are criticizing, but from what I see, according to Brembo, it should be a way of forming an alliance for technical cooperation. It's possible they want to use SRAM to replace DRAM. HBM is just DRAM, right? So using SRAM as a replacement. So using SRAM to replace DRAM, this is a change and improvement in the narrative logic. It's a technical supplement that can solve and enhance things, addressing current issues, but it's not a complete change. It's just an improvement. So this does increase future competitiveness to some extent, but I have to tell you this. Well, these 4 attempts may not necessarily succeed, because between SRAM and DRAM, DRAM is still more important. That's basically my understanding. That's the feedback I've received. If anyone has anything to add, we can take a look at everyone's thoughts. But if you really want to do computation, DRAM is definitely more important than SRAM, because SRAM is all fixed, right? DRAM is dynamic, so that's what really matters. When it comes to high volume computation, the more important memory is this one. Okay, and then on Friday, Facebook acquired this company called Manus, or maybe it's pronounced Manus, with a $700 million deal. They usually like to use the Spanish word for this because it means hand. So this AI startup is a Chinese company. Back then, it was known for its particularly strong capabilities in certain applications. But later, the company moved its registration from Guangzhou to Singapore, and then Facebook went in and acquired it. So this did slightly improve Facebook's narrative, right? So why is that? This is a startup, and it seems like it will help make up for Facebook's current AI competitiveness. It might even improve their long-term competitiveness, but it still hasn't changed things fundamentally. Now, why has Facebook's narrative logic been criticized before? The criticism is that you moved too quickly. After you acquired Alexander Wang's team, what exactly are you trying to do? Can you actually deliver huge results? After bringing people out, can you produce corresponding achievements? That's where people have doubts about them. If you criticize a company for improving the current situation, but not really changing it for the better, that's an important point everyone should pay attention to. Now, on another note, let's talk about OpenAI. Actually, in recent news, SoftBank has acquired an 11% stake in OpenAI. But this is actually a very typical example. This is an old narrative, right? You have angel investors continuing to invest in you. There's nothing wrong with OpenAI getting more investment. That's a positive thing. But the real issue with OpenAI's future isn't whether or not you have angel investors backing you. It's that you don't have a truly business that can operate. You don't have the ability to generate cash flow or profits. That's actually OpenAI's biggest problem. So this is the awkward situation of not having fundamentally changed anything. This did happen, but I think changing the world is just a narrative logic. It doesn't actually help. Okay, now there's something even worse. Oracle's founder is backing Alice with a huge guarantee, and Paramount wants to acquire Warner Bros. But Warner Bros. Is saying they're going to reject it, and next week they'll officially reject this move. So in this regard, nothing has changed or improved either. I think what we need is to improve and change the current narrative logic. For example, let's look at the CSB companies, like those few, Amazon, Google, then Microsoft and Facebook. And also Oracle. For there to be a change in the outflow of cash, there needs to be a significant player coming in with a large investment, and they have to offer an application that people can accept and look forward to. After that, things like agentic AI or hardware AI, physical AI, I guess. Well, I probably shouldn't say that. This hardware AI refers to things like robots and autonomous driving. And even further down the line, I see things like self-driving, smart manufacturing, smart glasses, and robots. Basically, when something practical like that actually gets applied, that's when I think there'll really be an improvement or a change in the narrative logic. I think if you want to see a real breakthrough in this area, you'll have to wait. All right, and honestly, we really don't know. Unless you're someone deeply involved in the industry, you won't know what's going to happen next. If you're not that immersed in this technology, you're basically just waiting for news to come out and for information to be passed along. So all I can say is you need to be patient because there are some doubts and you have to wait. So I think, why am I talking about this today? In the last 3 days of the year, yeah, these are literally the final 3 days of this year. In the previous 2 days, I talked about two other groups of stocks that seemed relatively weaker. The point is, we know AI stocks are going to face these challenges, so you might want to try looking at options outside of AI. Now, as for the information technology sector, let's take a look. This year, it still went up by 24.4%. The biggest contributors in the sector are Nvidia, Apple, and Microsoft. Why is that? Because if I remember correctly, this group outperformed last year. As for communication services, this year hasn't been great. So aside from the Magnificent Seven, we've identified a few categories that are really worth your attention. The first, of course, is anything related to semiconductors. These have seen pretty good gains. Among the semiconductor-related companies, there's KLA Corporation. Then there's KLA, Intel, Applied Materials, Teradyne, and Enphase Energy, which of course are among those with the biggest gains. For hardware-related companies, there's Avnet, Corning Glass, First Solar, and Cisco. Now, for software-related companies, there are some worth noting. The first one, of course, is AppLovin. It's an online advertising service provider, and this is considered a new application, so the market has had high expectations for it. For those of you who are interested in new technologies, you might want to keep an eye on AppLovin. In addition to that, in the non-core consumer sector, it's mainly Tesla and Amazon, but we have to mention that this year it's only gone up by 6.2%, which feels pretty weak. Of course, that's because the largest component, Tesla, is still down this year. Amazon also hasn't been particularly strong this year. So with the two biggest players in the sector not performing well, it's no surprise that the overall growth is lagging behind. As for what's inside, there are actually a lot of stocks in this sector, and we want to talk about a few of them. For example, Carvana is an online used car dealer in the US, and this year it actually surged by 111%, which was really unexpected. I wanted to mention this to you. I'm not saying that this is necessarily a good thing or anything like that, just pointing out that this might be an investment opportunity we wouldn't have thought of in Taiwan. I wanted to share this with everyone, so maybe it's something you should keep an eye on next year. There might be similar cases, things we didn't expect, but after doing some research or looking into them carefully, they actually turn out to be good opportunities. That's really the main reason I want to bring up these stocks that you might not usually pay attention to, so you can discover some promising picks. Now, there are two more I want to mention. When Trump announced reciprocal tariffs, the two companies hit the hardest were considered to be General Motors and Ford. Why? Because their parts, even if they don't come from China, they come from Canada or Mexico. But with these countries, China, Canada, and Mexico, trade negotiations weren't going well, no matter which one it was. So previously, they were relatively weak. But unexpectedly, General Motors shut down one, and both GM and Ford made some adjustments. In terms of management, it was either a personnel change or an adjustment to their product lines. The stock price for GM went up 55%, and Ford rose by 33.6%. That's pretty amazing. So even though their cars aren't that great, their stock prices look a lot better than their cars. Now, as for consumer-related stocks, let's take a look. I want to mention that brands still seem to have a strong impact. For example, TPR, which is the parent company of Coach, its stock price went up by 98%. So yeah, hey, if you bought their stock, you could buy yourself a Coach bag. All right, moving on. Ralph Lauren, which is the parent company of Polo, its stock price went up by 55%. Then there's Hasbro, which sells baby and children's toys and products, and that went up by 83%. Ulta Beauty also saw a rise, almost 40%. These were some of the stocks that were previously considered promising. As for discount apparel retailers, their stocks only went up by about 30% and 20%, which is a bit weaker than I expected. On the other hand, e-commerce stocks are still doing well. For example, Expedia, the travel website, which is one of the pioneers of online travel sites and is now quite well known in Taiwan, its stock went up by 53%. Then there's eBay, the classic American online auction platform. It went up by 41%. Then there's DoorDash, which is kind of like our version of Uber Eats or Foodpanda, companies like that. DoorDash went up by 36%. Now, as for travel stocks, surprisingly, they're doing pretty well. I thought they wouldn't be, but it turns out these travel stocks have risen quite a bit. For example, Wynn Resorts and then Sands, which is Las Vegas Sands. I remember that both of these companies have casinos in Macau. Back when the first wave of people were flocking to Macau casinos, I recall that both of these companies were involved. One of them went up by 40% and the other by nearly 27%. There are also others like Carnival Cruise Line and then Huang. At Royal Caribbean, these two went up, but Carnival, I think, and there was another one that actually went down. I might need to double check that, but basically these cruise stocks actually showed some movement. Oh, Performance. Sorry, Norwegian Cruise Line actually went down. There are 3 major cruise companies. 2 of them went up, and sorry, I got that a bit mixed up. So the ones that went up, and there are others too, that are relatively. There were some that went up, but I think the one that performed a bit worse was O'Reilly. I mentioned before that auto stocks should still be necessary, but although they did go up, the increase wasn't significant. O'Reilly went up, and then, for example, Genuine Parts, which is also an auto parts company, and AutoZone, which also sells auto-related products. They went up too, but the gains weren't strong enough. This might need some improvement. Needs to be improved. Also, there are some food brands whose gains weren't that great either. Yum Brands, which is the parent company of Pizza Hut and McDonald's, they both had only slight increases, especially. Generally speaking, when the economy slows down, McDonald's should actually benefit. But it seems like McDonald's hasn't performed well this year. I think the cost of food is... Of course, it must have been affected, which impacted its profits. Also, MGM, which is a casino, only saw a slight increase as well. E-commerce companies also had only small gains. Then there's D.R. Horton, the luxury home builder. They also had just a slight increase. As for the ones that dropped, there's gaming and then Lowe's and Home Depot. Both are home improvement stores. I mentioned before that there should be some rigid demand for these, but it looks like that hasn't boosted their stock prices. Domino's Pizza also went down. Starbucks, on the other hand, is actually doing pretty badly because it's a non-essential consumer good. When the economy isn't doing well, instead of buying coffee in the store, people just buy beans and make it at home, which is much cheaper. Lowe's is relatively weak as well. Best Buy, the electronics retailer, and the so-called 3 category stores are not doing so well. Nike's brand has also been pretty weak lately, and Lululemon is having a tough time too. Then there's Texas Outdoor. Texas Outdoor is also underperforming. Not Texas Dex, but Texas Outdoor is also not doing well. So there are still some weaker ones among these. But we need to point out something here. The part where weak performers turn strong is still worth paying attention to, but you really need to look at each one carefully. If we get the chance and have a good grasp on it, we'll report back to everyone. But honestly, it's pretty hard to catch this, and it's not easy for these to turn things around. The main goal is basically to catch something like General Motors. If you can do that, you can be pretty happy. And then as for communication services with Google and Facebook, among the 3 major sectors this year, this one actually had the biggest increase, up 33%. I think that's mostly thanks to Google's contribution. Also, in this sector, there are actually some stocks you might not expect. There are quite a few with an entertainment focus. I want to especially point out that when it comes to traditional entertainment, you'll see companies like Warner Bros., which recently went up 174%. Why? Because of a merger and acquisition deal, and there are people trying to acquire them. So when a company is being fought over, it's usually a good thing, so that's relatively positive. Raffles also went up 50%. Then there's TKO, which is the parent company of UFC, the mixed martial arts organization. It rose by 51%. As for Paramount, after being taken over by the Skydance Group, it only saw a modest increase of 15.1%. But since they're now trying to acquire Warner, Warner has actually benefited even more. So that's traditional entertainment. Then there's also new entertainment, like Take-Two, which is interactive entertainment. It went up by 40%. And then there's electronic arts, which everyone who plays video games knows, like NBA and MLB, and basically all the professional sports games that EA is involved in are doing well. The market grew by nearly 40%. This is roughly in the communication services sector. Next, let's take a look at what we want to talk about here. Among these three major sectors, it seems that the new giants are showing more divergent growth, so you really need to pay more attention and spend time looking at the details. As for the others, you can still pick out some individual stocks that are turning stronger. So just because a stock is weaker this year doesn't mean it won't have opportunities next year. So if you want to look into these, you'll need to do some homework. All right, let's move on and take a look. Let's see, either the performance related to this cold evil. So let's first take a look at this. The US dollar is rising today, but actually the moving averages are pressing down on it. So I think it's just a slight rebound. Then the US 2-year Treasury yield is going down, and the 10-year is also going down. All right, but the main thing, I'll switch over now, is to show everyone how the Dow Jones and European markets are performing. See, this is a new high. Today is the 30th, and for them, it's the 31st. I'm not sure if there's trading. Let me check if there's trading on the 30th. All right, so at these high levels, there's a slight drop. I don't think there will be much change today, but what I want to point out is that this is clearly a new high. If we don't use a very long time frame, let's look at the 5-year weekly chart. The main thing I want to show everyone is whether it's hitting a new high to confirm that it really is reaching a new high. What I want to say is that European stocks hitting new highs means that even without AI, they can still go up. So you might need to pay extra attention to whether there will be this kind of situation at the beginning of the year. So when it comes to your portfolio allocation or stock selection, you might want to broaden your perspective and think a bit more openly. Now, let's take a look at the US stock market. The Dow Jones is down slightly, and the S&P was negative just now but has turned positive. You can see there's some buying going on. So today, on the last day of the year, it's possible that they might things are a bit better, but if you ask me, I expect just minor ups and downs. Personally, I don't think there will be any big changes today. The past couple of days have been slight declines, so maybe today we'll see a small uptick. But since it's the end of the year, the closing probably won't be too exciting. Now, let's take a look at something else. Let's take a look at the pre-market performance of individual stocks. So Nike is up the most, about, all right, the CEO bought shares themselves, and this has influenced the market's outlook. Since the CEO is an insider, when they buy shares, it means they think the stock price is at a low point. So this is definitely positive news. And Intel stock price is also up, right? But let's take another look. Among the others, the ones with bigger gains include TPL, Texas Pacific Land. Lately, it's really been hot, so maybe we should check out what's driving it. Then Nvidia is also up, and Molina Healthcare as well. All right, both yesterday and the day before, it was because Michael Burry praised it, so it went up. So this should be Southern Company, which is an electric utility company. And looking at this side, actually, there aren't many large cap stocks among the gainers. Did you notice that? Aside from Nvidia, there really aren't any other major large cap stocks. So what about the decliners? This is real estate, right? This one is down. And WNB, this is Williams. Williams Company, this one is down. And CSX, this should be freight, right? Yeah, seems like it. there was a train derailment in Kentucky, so that was an accident, which is why it's down. And as for gold stocks, they're also relatively weak, probably following the changes in gold prices. Now, aside from that, it looks like there aren't any major large cap stocks going up. And if you look at FCX, copper is also down, but copper prices should still be trending upward. It doesn't look like the drop is that significant either. If you look by the fifth spot, there aren't any drops over 1%. The rest also don't include any big names with heavy weightings. So it seems like today is just a day of small ups and downs. All right, so let's take a look at everyone's questions. Earlier, before the stream started, I mentioned the countdown. If you're going, just be careful not to catch a cold, okay? I see someone brought up my morning greeting thing, but let's not talk about that anymore. It's already been, well, Xiao-En has already. As for the question you asked, the answer is no, we really shouldn't talk about it too much, but I can only answer your question like this. The answer is definitely yes, but you need to look at the hourly chart. You absolutely have to check the hourly chart, because for commodities, you always need to look at the hourly chart. If the hourly chart doesn't look good, then don't go against the trend in your trades. All right then. Louis Yang, thank you for your congratulations. Okay, so here he's wishing me a Happy New Year, so I'll also take this chance to wish everyone a Happy New Year. All right, it looks like there are no new questions, so that's about it for today's Q&A show. We won't be broadcasting tomorrow since everyone around the world is taking a break to celebrate the New Year. But we will be here on Friday. On Friday, we'll take a look together at 2026, what to look forward to, what to pay attention to. All right, that's it for now. See you all on Friday.
Our company has no improper financial interests in the individual securities recommended or analyzed. The information in this program is for reference only. Investors should make independent judgments, evaluate carefully, and bear their own investment risks. If you don't want to miss the latest market updates, be sure to turn on the notification bell and hit subscribe. In addition, we have plenty of great video content on both Facebook and YouTube. Don't miss out. In our group, we share in-depth explanations of global financial events with you every day.